Hello, people. Anybody out there? Anyone still alive? Oh, it's crazy week. Andre Ado, hello. Nice to see you. How are you getting on? It's a bit of a wacky couple of weeks. KG, hi. So we've just had core PCE, and that looks to be bang in line. The yearly figure was potentially. Oh, hi, Lucian. Thank you. Good to see you on the chat. Keep it up. Obviously, core PCE was in line. The slight uptick on the year number is, I said late on, I couldn't get hold of the consensus. My mate was missing. That's just going to be rounding. It was expected to be somewhere in the middle of that spot 2% range. I'll eventually get round to finding the number, but it's no biggie. It's just on the margin. So that basically gives the Fed enough ammo to next week at the meeting. They probably won't go next week at all. That's been ruled out with the GDP strength, I think. But they'll definitely start setting it up for the September, which is what the market says, and which is why we're on the CME tool page, because just that's interesting. You don't see it very often. Even a week ago, 1.9% of people still thought rates were going to stay. A month ago, 40% of people said rates were staying still. And now you've got zeros. You don't normally have that. It's complete market pricing consensus that the rate cut is coming in September. You've obviously been on the moon if you didn't know that. But it is instructive. Whereas if we go into July, 93% are now saying we're staying where we are. Now, this number, remember on Wednesday I showed it? That had gone from 4% a week ago. On Wednesday, it was up to 10% of a potential July rate cut. But the data since then has probably said we're just chugging along enough. Now, there's been a lot of debate during the week. I mentioned Dudley, the former New York Fed president, saying that not only should they be going, they should be going in July. He's changed his mind. He was quite hawkish. So the data's changed, and that is all about employment. And remember, he's talking in the way that we've been talking. Don't concentrate on non-farm payroll number, the establishment data, because that's all over the place. It is trending down, but there's revisions all over it. It's hard to trust. Whereas the one that is showing everything in the seemingly joined up way is the household report. Unemployment at 4.1%. That's showing you the demographics of where it is. It's all been drifting back. Now we're coming into Friday next week, non-farm payrolls, after we've had the Fed meeting, after we've had Bank of Japan, and after we've had Bank of England. So there'll be a lot more news to talk about, and we'll have a good idea. So I got a feeling unless non-farm payroll data as a whole misses up, then that rate situation will stay where it is. It's interesting once you start going down through the months. We've got November. Remember, I'll reiterate it. That November meeting comes 2 days after the election result in the States. So it's absolute nonsense if anyone's telling you that it's politically gridlocked, because it isn't. And by then, we're talking, a third of people think we've had one rate cut. 60% that we'll have had at least 2 cuts. And then we've still got some people thinking we're going to have 3 cuts for the year, and that's building. This could actually grow, as I said the other day. If the data keeps deteriorating at a quicker rate, then they'll have to do a 50 bips or a 75. So these things aren't out of the question. So playing the short end is interesting at the moment, and obviously that has been falling. The near-term yields have been falling quicker than the longer-term yields. That's called curve flattening, because it's coming from an inverted, and then when it goes upwards to right, that is a steepener. Remember that's the dangerous part. That is telling you that you're moving towards recession. Historically, it's not the fact it's been inverted. It's when it comes out. It's coming out because you're going close to recession or you're slowing down quickly. And we'll see how that develops. Have they left it too late, or will they be able to rescue it? And that just seemed to be a trend, doesn't it? Quick look. I mean, Minzy, don't know, can someone else answer in that? Good afternoon, Bletchley and Julie. So, we've been blowing up a little bit across the world, and we'll talk about why that's been happening. We've mentioned it on the chat during the week. What else we got? Don't need big super focus on Planty, do we? There you go. So things I want to talk about, just the Mag 7, obviously it's been this big rotation play. If anyone's been following my stuff, then you knew that was coming. We talked about it, didn't we? If we had that rotation, then the markets would come off because the larger cap will have more effect than the guys on the other side. But we've actually had a little bit of panic across the board this week because we've had some slowing down earnings in the consumer space. The autos have been absolutely slaughtered. Big car crash, literally, road crash. The household goods companies, slightly mixed. Unilever weren't too bad, but Nestle in particular missed their sales guidance. They've trimmed organic growth, and they have explicitly said, rather similar to what Pepsi had said, is that the underlying economy was not as robust as what people thought. A number of other sectors are talking about, particularly some of the airlines. Take out EasyJet, who said everything's all right. Ryanair in Europe, and then you've got Delta and Southwest Airlines in the States, all saying that pricing is becoming a little bit more elastic. People are reacting and not willing to pay the higher prices. And obviously luxury, that's been absolutely smashed to bits. Hermes was probably the standout one today because they've got probably a better product line within the luxury space, but most of them have been smashed in China. And it also, the demand pickup from people not spending in China that have still got the ability to have been moving into to play the yard into Japan, where the relative price a lot of things is for them, and actually lower margins for the luxury companies. So they've been getting hit with a double whammy of volumes going down and margins. So not for luxury plays. Outside that, obviously Mag 7 started off quite badly this week with Tesla and Alphabet. I mean, Tesla's a joke stock, isn't it? The way that Elon is playing with it. Having been smashed in Q1 40%, they then talked it up to then deliver a miss. So the number that was delivered was above the previous lower the range. So they've kind of done a good job, but ended up missing the new number, which is never a good thing to do. And they keep messing people around with the October date for the robo-taxi. So I think I've read a stat somewhere that EV sales are still going at good double digits, yet Teslas are down on the year. So is that just proliferation, rotation within the market, or is there a problem with Tesla? So it's in and out of being on the edge of the Mag 7. It's not really the bellwether, and it's his own little personal fiefdom, isn't it? Alphabet, slightly different, but that is still considered Google to be the old advertising model. So there's a stock in the UK, ITV, a TV model. They make more from their studio side in growth rate. But everyone still looks at it as a traditional advertising model. That's where they get a lot of their revenue from. So people can't get away from it being old school, cyclical. And it's taken a time for Alphabet to lose this moniker as well, because YouTube revenues was down versus about 3 or 4%, whereas the overall advertising spend was up. People were focusing on that just being a slowing trend advertising, and then spending to make money in the new AI revolution. This has brought forward this whole idea of, is AI capex beyond good rates of return? Is it worthwhile? So some of the high ratings on these stocks, we're obviously going to see a little bit of short-term pressure. Now, the ones that really move this sector and the AI and the proper cloud players are Microsoft, Amazon AWS, Apple, and obviously NVIDIA. Now we've got 3 of those next week alongside Meta. Meta has the same problem of trying to reinvent itself, and is considered to be similar to Alphabet. So expect that one to trade in a similar vein, particularly as they're out there talking about buying a stake in Ray-Bans to do augmented reality on sunglasses. I'm not so sure that people are really going to buy into that whole Star Trek idea when everyone else is growing revenues left, right, and centre. So obviously, so all those next week, and then there's a big gap between those and Nvidia at the end of August. So plenty of room for the rally to take place. Look at that in the short term, since the all-time high of the Mag 7 within the Nasdaq all-time high. Since then, the rotation between the Mag 7 and the Russell is 24% outperformance for the smaller value plays. In fact, I think I saw someone talking about financials. Some of the big banks indices are ahead of the Mag 7 after this pullback. So, there's a lot of panic going on, but we've put in quite a lot of retracement to the relative buy. They are still hitting, they're still beating. In the numbers, they're expected to slow. So whereas like nearly 100% of the Q1 growth rate in earnings was Mag 7, it's sort of down to around 40% for Q2 and expected to drop to sort of 20% for the Q3 and Q4. So it's already baked in the numbers that it's slowing down, and people are starting to talk about, it's slowing down. Whereas even Alphabet came through at 31% year on year for Q2. So these are still stonking growth rates. So we're probably creating enough situation in order to turn around. Now, historically, it's a month before the first rate cut, usually in September, that small cap outperforms. So it's gone a month early. There's a good chance a lot of that unwinds. And that's why I'm feeling, and I'll show you why on the technicals, I think there's still a chance that we put in one more high. On my chat, Fabo came through with some stuff from Goldman's, which is what I'm using supporting evidence in the last month or so in my weeklies, talking about this whole seasonal effect, starting with which we focused on the first 2 weeks of July being the best 2 weeks, and then it drifts. We've gone through that. We've had quite a bit more than a drift, but we said there was potential to put in one of these wave fours once we got to middle of July, but that there'd been one more takeout high purely because the timing of where these strong tech earnings are likely to be. So we should hopefully rally through next week. And we've got a very big day, 31st of July is when a lot of stuff happens, central banks and earnings-wise. And then that should be topping out. That becomes a time when it gets faded, because late August and particularly into September is when the market seasonally comes off, and it seasonally underperforms even more in a presidential year once that bottoms out in October, just like we did last year. You then get the end of year rally, but certainly it's an end of year election rally in presidential years. So be careful about fading stuff, buying stuff at the end of August. But I think there's definitely a trading buy either here, or if we end up doing a double correction, again, that will be a buy. But at the moment, I think we've got an opportunity to trade off yesterday's lows as a definite line in the sand. And some of the tech stuff, it's obviously had a decent rally overnight, but we'll go through that later. But a lot of the what happens, I was talking about this in my meme and the daily on my chat, is that when things get extended and things start unwinding and people get nervous, it's not always the traders that are in control here. They'll be told to get their books down, but it's not necessarily easy to do that, particularly in illiquid markets. So what happens is the risk teams sit above the traders, managing the whole risk of the entity, the hedge fund or the bank, whatever, family money, you name it. They'll go in and hedge, and that becomes price insensitive in a way, because they're just trying to get protection on, which is why you tend to see, and you'll be labeling it manipulation or whatever, but this is stuff that takes place outside the market trend. They're not, if they were looking at the technicals in the first place, they certainly wouldn't be doing when they're putting on risk off hedging. We've seen how gold, even, which is generally holds up as a hedge, was unwinding, but that sits in the category alongside silver and the base metal complex, which China's been hoarding, again, price insensitive, because they want to own useful metals, and they also on the side want to be dumping the dollar. That's been the predominant trend there. So a lot of that was starting to unwind as we're seeing copper melt on the back of poor Chinese data. So there was no hiding place in gold, and that meant that the currency safe havens were coming into play, the Swissy, the yen, and even though they're cutting rates, a little bit of bounce back in the Chinese yuan. So it was kind of an intra-Asia secondary play. So when that's happening, you're in a risk-off carry unwind trade. That means that when you've got the carry trade on, you're long of something, so people are unwinding all the outperformers, which I just described, precious metals, and a lot of the nervousness amongst the large cap US stocks, particularly techs. So it becomes a self-fulfilling cycle, and you've got hedging in place. So what also happens there is you get unwinding. People will then work their orders against that. So they'll be taking off the global hedges of the indices while they sell the underlying. If that continues, they might just decide to hold on because they're hedged. But this is where you start to see some consolidation come in the indices. Why we should be bouncing, and we are. Then the test becomes the hedge levels are neutral. What people do? Do they then decide that underlying trend is going to continue, or is it unwinding? To me, I feel like we're a little bit stretched on the relative value play versus Mag 7. I'm anticipating the rally continue. You guys may differ. We'll find out when we run into a consolidation range. Currently consolidating the Nasdaq bounds for the day. That's waiting to see how it opens. So a big week next week because for the yen, and we'll show that. We said 155 option. Was that a trick one, or was it really the 152 barrier break where it would be defended? That's the one it hasn't managed to get through so far. So to me, that feels like there's still people sat there. The data's come through okay, but there's nothing really convincing that they will put rates up. And if they do, even if they put it up 10 bips, I think that will be seen as underwhelming. They'll be doing their JGB pullback 6%, 6 trillion per month. Likely to go back to 5 trillion yen purchasing. It needs to go lower than that, I think, to get the market believing that they're pseudo tightening. And we'll see what comes from that meeting on Wednesday morning. Then you've got the Fed in the evening, and then we've got the Bank of England on Thursday. So lots to move the relative pairs around, but it does seem to be dollar. The dollar is in a situation where it should be rolling. There's negatives going through from the rate cycle, so we'll have to see how that plays out. There's potential for it to do a short-term bounce, but really, I'd prefer to see it put in the one more down leg that it should have. Get this final blow-off risk upside into August, and then it's due a decent bounce. That would be in line with a bit of risk off, and we'd be back to being able to read the market a little bit better. And also within that gold physical buying scenario, we know 2,300 was a big level. We saw tons of contracts coming through from the CME at the start of the month. First half of July, last week, we saw the paper guys really lean into it when there were very few closing contracts, buyers asking to be delivered, etc. We'll see how that develops in the next few weeks. There's been a few attempts to get through 2350, and that does look on the chart to be a very strong area, 4 or 5 wicks off that. So a lot of people will decide that is a proper order block area. It's definitely a support of some kind, but subject to news, we can just go straight through that. It's not. I think 2,300 is definitely the level that will hold. It most likely. It depends where we are within the actual wave cycle. I want to look at that because I think there's 2 or 3 options for where we can go. I'm leaning towards there still being one more high. We've had this choppy nature ever since the May top went in, and we went sideways before we put in the latest all-time high. It's been complicated. There's been lots of low gradient impulse. It'd be just classic, ironic that it'd be an ending diagonal overlapping 5 waves to finishes, and then we should have a decent pullback before we go into seasonal strength at the end of the year. So a lot of these things feel like, if you are long and wrong, it's possibly worth holding on for on a number of these things until the levels are actually broken. Otherwise, you're just locking in volatility. So peak shocks, we talked about that. Dollar weakness again still feels to me like what once we get the cycle starting, that again will be read by the market. It's a little bit of travel and arrive, just where we are. It'll give me another reason why the markets sit back. They'll then know what the path looks like. Where's the new net marginal positive coming until we get into the seasonal inflow strength towards the end of the year. So lots of choppiness, lots of finishing off the 3-4-5s. Remember, we started this in June, May, then into Q3, the end of Q2. It's so we talked about 3-4-5s at the start after April that we'd have this. It's played out pretty well. It's now just a case of trying to manage the top end, which is difficult. It's calling the end of wave 1s and wave 3s tricky. You prefer to buy in the wave 4. We're in consolidation wave 4s at the moment, so there's more confidence to be having at least trading buys, and then we'll see whether we can just eke out and squeeze those higher highs. There's no mermaid, Edward. Where's the mermaid? What we've got. So yeah, we've also at the end of next week there's non-farm payrolls, which we need to keep an eye on. 4-2 is now being talked about by some of the strategists for being the final nail that the Fed needs. That they may obviously they won't have gone by then, but that they'll probably hinted that more deterioration in the unemployment rate is what they're looking at. A lot of the people, former Fed governors, the Dudley, etc., all strategists talk about this thing called the SAHM rule, SAHM, which is on the 3-month rolling average of the unemployment rate. Once that has moved by 0.5%, that is generally a signal that things are going down the pan and that you're heading towards recession. So everyone's aware of that, and we're very close to that happening. I think once you get to 4-3, 4-4, that starts to get baked in. So it doesn't need very much of a change. And what you'll find with the data, the household data that they do the unemployment rate from, it's not just about the actual number of people unemployed. The divisor moves around quite a lot because of the way that their system is, people entering and exiting the labour force. So you could suddenly hit that number, 4-3, 4-4, if the divisor suddenly drops quickly, and you sometimes get that, people getting fed up, not being able to find a job, they leave the workforce, don't sign on, etc., etc. There's various reasons why they leave. So just be careful that it sounds like a jump from 4-1 to 4-4 is going to take months. It can suddenly happen in 1 month just based on the makeup of the inputs. It happens, and I've seen it many times. So yeah, the thing that we need to start working out for August, September, the proper pullback is, so late August, sorry, is where is the money going to go to? What safe haven is it going to be? Is the dollar going to still see inflows and be the safe haven again? Or do we get the switch back into the precious metals, etc., etc.? So we need to have a think about that, or is it all just going to be the bond trade? The bonds quite are going to be, and have been the last couple of weeks, a big recipient of the money market funds starting to come out. The more that short-term yields start falling, then the less likely it is you're going to keep your money in there. If you want to go risk off because the interest rate cycle is starting, then you're probably going to go into some duration, which means longer-term bonds, just to get a big bang for your buck. That's the geared way of playing the bonds. And as we can see, all the auctions this week have gone really, really well, the last 2 weeks. So there is money coming in for that. People have been talking about, China selling, Japan threatening to sell. Is that, and the massive auctions that are coming through, which reminds me, next week, it may be in some of the calendars, but tends to get ignored. It's a quarterly refinancing announcement, which is when the Treasury tell you exactly where on the curve they're going to do their issuing. Now, at the moment, they've been doing quite a lot at the short end, trying to get away with being able to roll over while there's been demand for high short-term rates. I mean, that might have to have a bit of a rethink. People are probably thinking they're going lower, and they're actually happy to invest in more duration. So they might actually be able to get away with shifting down the curve, which will be good for the banks because they'll be able to make a bit more money. Because that is quite all over the place, monumental. Point of note as well, the last figure for Atlanta GDP, which covers Q2, was the one on Wednesday. So from now on, the Atlanta GDP is talking about Q3 GDP, even though yesterday's GDP was just the first provisional read for Q2. So it's this provision. Atlanta are always forward forecasting. They've just been finishing off in line, and they've been telling us it had bounced from that weakness we saw at the start of July, end of June, when it was down to like 1.5% for Q2. The next bits of data pushed through that sausage machine, told us 2.6, 2.7, and it came out at 2.8 for the first read. So that's been a pretty spot on thing to follow, which is why I say you should follow it, because it does give you real time post big data updates and give you a feel for where the economy is going. It's really the main reason why people gave up on the July cut. If Dudley hadn't have spoken this week, it would never even have been on the radar. So obviously, we've got Michigan at 3:00. Keep your eye on that. 1 and 5 year, but it's really the sentiment underneath which the Fed are starting to look at, because the consumer is resisting spending and they're moaning about it. On good inflation pullbacks in that survey, they've still been letting their sentiment drift. So keep an eye on that. Hopefully, you all saw Canada cut rates as expected, but it was what was in the narrative. They themselves are now focused on slowing growth, totally given up on prices, and also reiterated that they are very happy to be decoupled from the Fed cycle. I think their next meeting is before the Fed as well, so that's almost a hint that they might be cutting again. So factor that into your Canadian dollar outlook. They are remaining dovish. I'm not slipping here, King. No slipping here, mate. If you've got any issues about anything account-wise, please go and speak to Alex in the public chat. He's the man. One, I can't do anything about it, and two, I haven't even got the tools to check. So it's pointless coming to me. I hear you having issues with what is seemingly supposed to be a more realistic environment, and maybe it's an education thing. I saw what Faber had put on. It didn't seem great, but I'm not party to what's been going on. So please take your individual issues to the support if they have got the ability to try and talk you through why you got the feel you got. Not just a blind, no excuse. They will help you. Talking heads, I said, they're going to be very quiet because everyone's in lockdown, and there really hasn't been much at all. Some of the ECB guys have got their speeches if you want to go and look at them, but they're all nothing really to say. The Grundos interview on Tuesday that is quite interesting because he goes into the actual methodology. So if you're really interested in fundamentals and wanting to know how the central bank looks at making decisions, what they look at, sort of trends they're looking at, what data points, that is a really good release on the ECB website. Very good, very interesting chat, especially if you need to get to sleep on a Friday night. So yeah, most of the European comments have all been at just special conferences with very little to be said. The US guys couldn't say anything anyway. So Logan and Bowman on Wednesday were just at this community partnership stuff, quite dull. ECB's Lane didn't do anything. Book, again, that was a internal policy thing, and that was looked quite boring. Uh, Nagel started making some comments yesterday. Again, he was at a G20 conference and made some comments aside from that, where he said that they should be able to deliver rate cuts if the data allows, but they're not on autopilot. They're in restricted mode until things look better. So it's not like they're just waiting for a particular data point. I do think they're going to 2% in a bumpy fashion, so no change. But he does think that the greedy inflation monster is tamed. So for him, that is quite a revelation. Because normally he sees inflation in a dark room. But at the same time, we had other people talking. So Slovakia's Peter Kazimir, their governor, he's still talking about only 2 cuts is not entirely misplaced. So no shit, sure, because they're going to go at the same time as the Fed, probably in September. To me, it's whether they do 3, like people were looking for a couple of months ago. And that is pretty much what Clara Raposo of Portugal then came out and said. Well, she said there's still probably room for 2 more cuts. I think there is. And there's every chance for 4, because if the Fed comes through with September, November, December, there's no way in the world the ECB aren't going to stay in line. You know, things will get better from a cyclical basis, obviously in the US, but everywhere else, just from the fact the rate cycle started. Earnings are based in Europe. They should be picking up. As we said earlier, the US 493, those that aren't in the Mag 7, this quarter is the first time for 2 years, I think it is, that their earnings are positive for the quarter. So that is cyclically picking up. It's all about how much they're beating that by, whether it's in line or not, etc. But it's still an uplift, and it's going to get bigger as the year goes on. And if we're now getting what they call policy insurance, the rate cuts, then things should improve net. So it all becomes slightly self-fulfilling, that as long as inflation pressures don't come through, then they know that the real rates are too high and they will get them down. They need them down 10 plus all the regions. But that will also alleviate a lot of pressure in Asia, because they will be able to cut their rates. They were the ones that got early and started cutting, but then starting to get too far away from the Fed, it starts creating issues we've discussed before. That will allow them to start kickstarting their economies again. It's all becomes self-fulfilling. But like I said, I'm expecting it to lead to a travel and arrive issue for the US and possibly Europe from the indices in the short term. Much outside that. So obviously there's a lot when you get the preview on Monday. There's gone through loads and loads of results. The net of which seems to be that there is that, as we discussed at the start, there's underlying weakness, but there are real spots of outperformance from the right parts of the economy, like even in AI, ServiceNow, which is generative AI taken into individual companies to improve their productivity based on their own work practices, rather than just buying an off-the-shelf model. This dive nuts and bolts deep into the company and get things moving. And they showed real benefits, and they were off the clock up 13%, growing mega quarter on quarter. They're the poster child for what AI is going to produce from a business perspective, services and software. And I thought it was interesting. IBM, the big blue, which is pretty dull normally, software side, the benefits, but in their results, talked about old mainframes. So mainframes and got obviously old software running on them. Normally, they see the run rate of income from them decline as they become obsolete relative to the newer versions. But they've been using generative AI to tidy up, clean up the software that's running them, actually give them new life, and they're actually unexpectedly running a level profits for 3, 4, 5 years old. So that is a massive under the hood benefit and positive that probably will come through more and more, as this is what you're looking for productivity gains from AI. So while everyone at generic is just saying, "Oh, you're spending, spending, spending," there is a lot of positivity coming through here in realized benefits and products that is largely not talked about by the strategists and in the mainstream. But I think that will come through more and be another reason why this probably isn't the top of the market for tech. That it is probably at the beginning of extra benefits than what people imagined. So I noticed Taylor Swift even couldn't rescue Universal Music Group. Their subscribers were shocking, having only just refloated, whereas Spotify was off the clock. Um, Again, so we've got Ryanair versus EasyJet arguing about airline prices in Europe. Complete opposite performance. Got Coca-Cola and Pepsi, complete opposite performance. Unilever, Nestle. So you just got to be careful about totally reading too much into the doomsters in the economy, because sometimes a lot of this can be stock specific, but it's just enough to show that there's some weakness in there. The crucial stuff that's come from the CEOs this week has been all talking about the consumer moaning about high prices and that they're not paying them anymore. That tells you that inflation's about to fall off a cliff from the retail spending. People are becoming more discerning, marginal discretionary spend. That is what causes data to suddenly drop. That's what stops companies suddenly hiring, if not firing, etc., to get their costs down, to keep their margins up. The Fed knows this is what's needed. That's why the market has seen the pattern before, and they can see the rate cuts coming. But this is classic, which as much as you can, and you can't trade them, but eventually you will, and you may move on to them. Good to know. And Drew mentioned this at the conference. It's so important when you trade an index to know what moves that index, what the big weights are, which sectors are heavyweight, and then when you go through an earnings season like this, you get a feel for what's going to affect that index. Or you might say, "Oh, that's off the clock. That stock's up 20%, but it's going to have like 0.2% of an index move, and that isn't going to be the thing that moves it on the day." And then it also gives you good trends, and then you can spot the macro trends. And so it's micro stocks, bottom up, macro top down. Two ways of looking at the same thing. Often they overlap. Often they tell you something completely different, and that is where your edge can come from. So we can start spotting from the mining companies that were saying their production was low in certain areas and the demand was low in other areas. They're starting to tell you what's happening in China by default, and you can start thinking, well, obviously copper's overrun a little bit, blah blah blah. You start to build a picture up. So ignore rather than Alphabet. I think SAP was the biggest read for what's possibly going to happen next week. They had a big beat on cloud revenues, up 25%, maintained their full year guidance up 2025, because we're halfway through 2024. People are normally focusing on earnings a year ahead, and that is what will be defining the money flow and the ratings. So once you start to see people talking about 2025, or it might be 26, subject to what quarters their yearly updates come in. Basically, 1 year forward earnings is what you're looking at, and that is what will get things going next week. So keep an eye on that. That's the commentary we're looking for. So again, no one has said a peep about anything. Is anyone there? Edward's there. Cool, I suppose. You got any comments, or should we just go for start looking at some charts, I suppose? You're watching the FTSE. Okay. What do you think? Because when you're looking for breakout earlier, weren't you? Just by look at you got pullback. Nice. Reactor. Nice to see you. Nasdaq is hard. It's absolutely hard, and I'll show you the reason why I think it's hard at the moment. Just literally can go two ways. Both of them are seemingly valid, which is why I'm saying it's potentially a trading buy. If yesterday's late low was it for leg one, it could be enough to be the overall finish. But a lot of these things, when we talked about the 3, 4, 5s before, once they start folding into complete sets of 5 waves at high degrees, the problem that we're having with some of these indices is there are 5 valid waves in play for the top. It's just whether that was the last wave or not. And at the moment, they haven't done anything to negate there still being further upside, which is why it's tricky. And I'll go through that in a minute. I just tabulated all the manufacturing and services this week, just because it's easier to look at then, isn't it? They don't all give you the composite. I think you can find them if you go into the individual bits, but it doesn't really matter. You can really guess where they're going from the underlying bits. Aussie surprisingly had a manufacturing bounce, which with everything that was going on with the China slowdown was slightly surprising, but it is still in contractionary territory. So services just dropping off might be the thing that saves the mortgage holders come August the 6th, because that might just be an early sign, just enough for the RBA to hold off on the rate hike. Good look for all those people that are squealing and having to sell their houses. It's becoming a real problem in Australia. Japan again, teetering on, manufacturing not really taking hold, but it's the services that really matter over there, and that was a big jump for what was it, for May, wasn't it? We're in no, for June. Sorry, the June figures. India keeps bobbing along. The real high driver in Asia. I don't know if you caught what I was saying in one of the days. There's a bit of whinging going on in China about this super low Chinese yuan situation and them cutting rates relative. They think they're going to get a load of imports dumped on them, and they're struggling to be able to compete necessarily in a lot of those areas. So just slightly concerned their economy is going to get skewed a little bit. So again, the reason why we need the US to start the cycle so that everyone can start getting into line. Germany, road crash. Again, literally auto policy nightmare, everything under the hood, and services slipping back. But that is once you're below 45 on the PMIs, you're in a technical recession. This is there and now starting to slow down even further. So they've got mega problems in Germany. Obviously, being the biggest, that's taking off a lot of the pressure Eurozone wide, which is why they're going to be able to go with the Fed. They'll be able to use the German excuse, which net, no one's really going banzai, and they're on the verge of going into manufacturing recession as a whole, and services as a whole slipping back. Composite only just holding on. Worrying times. That's the reason they've gone data dependent, not data point dependent, in the Eurozone, because they need to go as soon as possible. They're only holding because the States, they don't want to get out of line with the US. They're scared to do the Canada trade. That's annoying, the GBP figures, but hopefully they'll look through it next week, close their eyes and go, you just got to get in line. It's two-way pull. It's not really showing any mega signs of acceleration. We saw the inflation figures had a swift influence last week. Services slightly below expectation for the PMI. Manufacturing, I jokingly said, and it's probably true, you often get, if you win a sporting event, or if the blue collar, the working men see something that he likes, Labour is very unionised. Is that a bounce back effect when they knew that they were going to win the election? People suddenly Yeah. Putting it in, or is it signs of underlying demand? Probably being facetious. But that was surprising, the US one. What on earth is that? Oh, that flying hearts. Thank you, Shabazz. So yeah, US yesterday, bit of a mix, or was it Wednesday? Was it bit of a mixed one? I wasn't in for that one when the manufacturing obviously dropped. Now, services is the biggest part of the economy. At the margin, is that going to stop them doing anything? Probably no, because they're already because that is a diffusion index. The prices paid, if I remember rightly, were subdued again within that report, or they certainly weren't accelerating. So it's nothing at the margin that's going to get in the way. A lot of this we'll talk about on Monday because these are talking points of what are going on. Yeah, we can deal with all that on Monday. So yeah, let's have a look at some charts. So there you go. Gold edging higher on Treasury yields dropping. So there is there's a chart that will be in the weekly preview, which is about how gold reacts versus 2-year yield. And when 2-year yields start dropping, is the real precursor to that. Even yield curve we've been talking about. That is when the real driver, real rates of the economy are falling. That is what gold is driven off. So whenever you get a falling period of 2-year yields, gold will go up. So you've got to keep that in mind. Whatever happens in the next month or so in terms of a consolidation, Q4 is set up for breakout. Most of the investment banks have 2,500 to 3,000 in for year-end target. They know what's coming with the rate cycle. They know what's coming on the physical side of things. Be very careful about outwardly shorting gold. It's still, as a swing trade we're talking about here, you're going to find intraday pockets, but being short gold into Q4 will be quite dangerous. So look, obviously we've got another month and a half before that really starts to become a play, but use weakness for strategic buying if you're able to. And we'll have a look where we could be going in the next few weeks from this. So Julie was saying, where are we on the walking up and down? Well, post that number, we've gone into the upper band of the Bollinger Bands. We're trading above it. So the LPR boys they've got the rosé in the fridge, Perrier Perrier rosé, and they're just going to see whether that happens to stay in that channel for the rest of the afternoon. Again, it keeps bouncing off attempts to sell off back into the no man's land. So just be careful of shorts at the moment until that breaks down. So I just went back to the daily chart for a while just to see where, because at the moment, from my point of view, we've been in this minor wave 3, the red 3. That's what we've been trying to top out. Remember, we had this very choppy month of June into July, where we eventually put in. So May to the May top to the June the 7th low ended up being that 3 wave for the wave 4. It's all about putting a new all-time high with 5 waves, which we have. We didn't really have any impulse. There's a lot of fade to it, but in order for us not to be still in the process of putting in a higher high, this to me still has the look of a 1, 2, 3, 4, 5. 1, which is here, and 4, where we currently are, have overlapped. So that tells you that it's not a classic 5-wave move for Elliott wave. But if it is supposed to be in a wave 5, that is the last wave. and it's a 5 of a 5. That can be, that's definitely setting up as an end, what they call an ending diagonal. Leading and ending diagonals are the only time, the way that I look at things, where you can have the overlapping waves other than within corrections. And if we're still in an impulse, this is still valid until we take out that June the 7th low. So that gives us a lot. It's unlikely if it goes below the 26th of June one, and that's properly invalidated. So he's coming in at so basically around 2300, which we know is a testing zone. But before we get there, and we'll look at it in a minute, from what another guy was saying on the chat today, and it's equally a chance that we do get this rally up towards 2400 from here. If we were to then sell off again, first valid stopping point is sort of 2330. That's a spot 618 pullback. That's what he was looking at as well. And there is a big demand zone around that 2350 to 30 sort of area. So it's a natural position where we might see some demand coming in which case that is still valid because it's above the wave 2 and we can bounce from there. It's a small overthrow from what is the existing channel for 234. Now, generally, you get the overthrows bigger at the top end, but you can see here in the subwaves before we have had an overthrow that did come back in and ultimately take us to the other side of the channel. It does happen. And I do think we're set up in a similar way for this subwave 4 to turn in here if it's not already turned, because we've got this first 3-wave move down is an equal length from this. What day was that? From Thursday's high, Wednesday into Thursday session's high. So we're on a valid position to bounce off the bottom of this trading range, elite wave trading range of 2, 3, 4. Once we get into 2, 3, 4, things start to get a lot more accurate. So wave 5 top at the other side of the channel is a new all-time high, which is why we need to be just too careful about getting overly bearish at the moment. I want to see things break down first. But once we've put that in, we have got the potential for this high mid-July being the actual 5th high, in which case if we're doing the very first of a double, when we're talking about wherever this next rally finishes, equal legs takes us down to that 2280, 2270 region, and then in order for it to not be something different, 2200 comes back into play. So there is potential still for a deep pullback, but I think we run into some heavy physical buying down here, which may make this properly complicated, another bounce back before we ultimately come back down to that range. That'll be choppy, but I'm just willing to give in the first instance until we take out that 2330 level. I think there's a chance that we still could put in this overlapping ending diagonal. Shabazz Saeed, you're long in EU. We'll have a look at that in a bit. So that's the sort of daily chart, and it has held the 50-day moving average pretty tightly, which again we are challenging, aren't we? Yeah, we sat right on and have bounced off this morning the 50-day moving average back into the channel. So that could continue to be very strong confluences here. So yeah, so 4 hour on the Bollinger Bands has come out of its on the back of that rally this morning. It's come out and stayed out of the bottom channel. So that's in no man's land at the moment for directional purposes, but it's come out of the negative trend. The only thing that you would say is that at some point it is going to cross the bands, because we've had that crossing in this low volatility period during Wednesday, where it went through the top. It's walked itself down on the lower side of the 2SD. So at some point it is going to cross. It's just whether the momentum dies or whether this thing picks up. Again, if you want to trade this, which you have to trade, then that is a buy with stop loss in this lower band. Again, remember when 3/4 of it is trading in the lower bit. So that unfortunately gives you a 1% range on gold. That's quite wide, subject to how you trade. The hourly one on, so that was a 3, 4, 5. So the first resting point did respect that order block, didn't it? It bounced off it, but soon waned. If that is the top, that's the equal legs that we're talking about. That's failed, just short of equal legs, hitting into the zone that what was it? Gustav was talking about yesterday. In that low 23.53 area, we've bounced off that. This is all a case of, is this a connector or is it the start of a breakout? So again, we've got to get through some choppy area here to see whether we keep going. Next week, you fancy gold for 2,400. Well, I hope you're right. So I kind of think that is a testing point, as we said on the daily chart. That could still be part of that could be a connector before we come off again. It just feels like we've reached sort of point of maximum pessimism. Lots of V-shape cathartic action going on in a number of instruments. You know, quite deep MACDs and sequentially lower MACDs on a 3-wave move. That's bang in line for a correction. So obviously higher highs from this. Now, if this is going to be a wave 5 overall, then the momentum should peak out a lot lower than that previous one at the 3. The previous 3 to that is where we saw the previous all-time high to that. So they're the 2 highest spikes on MACD. The wave 5 normally will be lower. The only thing we've got to caution about there is this wave 5 is to complete wave 3 of minor degree, which is obviously a wave higher. In this respect, this wave 3 is a higher degree than this one, and they were slightly lower. So this should be a situation where potentially for a wave 5 we will get a higher MACD because it is it's a high degree topping out scenario. So just be careful on looking for divergence to be the signal to fade the rally. I think that's key here because this minor wave 3 is the daddy boy sort of workaholic wave of the uptrend. But that's kind of encouraging because we should overthrow this channel for the blue waves. The black channel is up here at the moment, 2,600 plus, and a wave 3 flip in the middle is my original 25.50. That kind of feels like they're crossing here in the middle of August, all around the time when we start seeing all this risk-off unwind nonsense again. So this might be the important overthrow coming, as opposed to staying in the top of that channel. So unfortunately, a lot of if buts and maybes again for that, but we've certainly got a stop loss at yesterday's low. There's a reason to play gold on the long side because it hasn't broken through. So I don't think it's bearish until we take out outside the channel and through that demand zone. Any questions, ideas on gold that you want to talk about? So again, Julie, the LPR is getting colder. It's even, I might put the glasses in the fridge as well now. But walking up, still outside the upper bound of standard deviation. So in the short term, this is one where you'd be wondering what's happening at the 4 hour, but here in the 15 minute, it's telling you that we're still in bullish mode. Excuse me. Excuse me. I've got a frog in my throat. Excuse me. So we'll look at a dollar first. That's part of the EU analysis. So setup to me is that we're in the fifth wave of 5 down. So put in this first minute wave. Excuse me. And then we've got this pullback due, which I've been talking about, to line up with sort of, need to move this cross now, this mid-August idea. And then we can start seeing some consolidation. Might even go, that can go anywhere back up here. So that is possibly back into a risk off kind of scenario. We'll work it out once we get there, but we should have some short-term weakness the way things are building up for next week and beyond in terms of the rate cut outlook, and whether that is coming from guidance from the Fed and or cemented by non-farm payrolls. Looks like we should be getting one more to account, but we're still in a kind of choppy consolidation in the short term. We've been impulsive all the way down so far until we started going back into the predicted wave 4 consolidation. There's obviously a chance that this could do a double anywhere in here all the way up to 106, but it's not my first sign for the minute. I still think we've got to put the fifth wave in, finish this pattern off. So that for me tells us that we're in short term. The gremlins have returned. I did click on that chart. Right, is that back? I think we're back. Yeah, brilliant. So to me, we're still in the 5 waves down. We've got 1, 2, 3, 4, and 5. And again, from what I talked about in gold, the fact that it's overlapping with 1 doesn't matter because it's 5 waves making up a first wave. So we're happy. That's all still valid, etc., etc. So I think that plays out over the next couple of weeks. Really, at some point there's going to be some more impulse in amongst it. So that should be happening. Hopefully, at least a surge into next week, then consolidates and then goes again, and finally finishes. Then that should take us into a risk-off period that we're talking about for equities and risk assets. Then the dollar possibly sees some safe haven flows short term, and then we're right into all the election nonsense. So that's going to flip flop around on Trump being in the lead, etc. Harris coming back. So yeah, again, just on the MACDs, the lower MACDs are all in sort of wave 3 positions on the way down. Yeah, I'm happy with that for the minute. We should be putting in a lower low here, but on the higher MACD than what's showing there. Right, one sec. Right, I'm back with you. Here we go. Yeah, so by definition, the euro is going to be the opposite of that, with it being 56% of the DXY. Obviously, the curveball for DXY and why it's going to be slightly choppy on the way down is UJ next week, with um, required weakness pretty much dependent on the combined mixture of the two meetings, whether the bodge can manage to manufacture some strength out of it, um, despite not actually doing much. That's going to be the real test by the end of the week. So we talked about on Monday, is this a valid wave 4 here, or are we connecting to go lower and do a double? And that pretty much reached equal legs. Since then, to me, it looks like we're nesting slightly. So we've done a 1 up, 2, a 2 retracement because we didn't take out the low, and then another subwave within that. So it looks like we're grinding up. So again, to me, it's a buy with that 108, 108.24 kind of stop loss area. Probably go 108.20 just to give yourself a bit of room. And I'm expecting that to keep moving up. Grab that over there. Obviously, time has caught up with us, so all this needs to be moved across. So we're in a fifth wave on the way up, just like we're on a fifth wave on the way down on the DXY. I've stuck with it. I still think it's the case. It's 110 is where we're going to come before we start having some kind of consolidation. Might even get 111 out of that with some choppiness. Why does it suddenly retrace despite the fact the EU are going to be cutting as well? It's literally because they're going to stay in line, aren't they? So it becomes a relative strength situation for the dollar. So we're going to get the wave 2 sell off into here as the dollar sees safe havens. And then hopefully, once we get the market rally back on, we've got the chance for breakout after the September risk off rally. So we've still got decent upside, I think. You've got 2 big figures, as it were, from 108 to 110 plus. That's how I'd play EU. What are you thinking, Shabazz? Shabazz, you still with us, or have you gone? You're already long at 108.80. So you're small offside at the moment, is that what you're saying? You're hoping it comes back, goes back up. Okay, that's good. So did you buy one of these pullbacks that held on? That yeah, cool. That's good. Like I say, just be careful that we don't end up doing an even bigger correction. That's why I want to use that as a stop loss down here. But I'm pretty sure that we're doing the opposite of the dollar for the moment. Both of those net should play out. I don't think we're going to get. I think it'll be a truncated further sell off if we get it as well. What do I mean by that? That is we sell off from there, I think this 107,990 is a kind of stopping area before it would to go again, and it'd still be valid with the rest of the pattern. I just think it's a case of when, not if. So it'd be short term, second attempt at the whole risk off situation within the confines of what we're doing at the moment. But at the moment, I'm just going to give the whole spectrum of instruments the benefit of the doubt that we're bouncing. GU is going to be interesting because we've got the Bank of England next week. Move him out of the way. So again, that has ended up being the double. All of these things we were saying on Monday. Is this the start, or is it just the connector? And it's been the connector, as we know. So you're looking for a sterling yen sell, waiting for pullback. Yeah, just be careful that who's coming first. Yeah, the yen, the Bank of Japan comes before Bank of England this week, doesn't it? So make sure there's not a load of weakness there ahead of. Well, if you're looking for a sell point, that might help you. Sterling might not do much until we get through the week. But if this is, and that is on a spot 618, so it is a valid starting point, that obviously has to be a stop loss. I prefer to see equal legs or closer to equal legs on the first move down, but that is a valid stopping point. So we should be potentially into upside. It's just how it's going to react to if the UK does what I think is kind of expected. A lot of people are still on the fence as to whether they're going to move this. So this might actually be waiting for an equal legs, which is down here, and that's on again the 50-day moving average. I think it is anyway. No. So currently it is sticking to the 50-day moving average, isn't it? And that is currently a resistance level for it, which kind of helps in what I'm just talking about, in that we're highly likely to have one more sell down, even if it then just brings them back into line with the ECB, because that should be interesting if they find the wherewithal to cut rates and it isn't a big jump to get the numbers the right way. That all of a sudden we're back on looking at the UK in line with Europe rather than in line with the US. But I think it might be a case of a little bit of shock sell-off on the actual performance of that versus the rhetoric potentially saying that they need to see a lot more data destruction before they can go again. So, but actually, yeah, I think that by the look of it, is a good trade because that is too tight in here to take as a buy. I don't like the fact that it's got to break the 50-day moving average right now because I don't think the momentum is going to be there until later in the week. But I prefer to see equal legs for the first wave down. It's the second one when it goes into a double that I like to see it weakening to show the weakening trend, whereas this needs a bit more, I think. So yeah, stick with that. So you go for the 200 exponential. Yeah, no, I wouldn't put you off that. I suppose on the hourly chart, yeah, 50. 50 is just 2 days, isn't it? Really. That's why I had 750 in. I've remembered now. It's, I'm gonna go back to that. 750 is my 20-day moving average. That's why that came in. Remember why that? I was wondering why have I got that at 750? Okay. So UJ, which we've been talking about, and we're in this. We've got it in as a high degree cycle waves at the minute, of which we, as soon as we broke the channel, we said we've probably got problems. This 345 needed to fold in, which is what we said. So that meant that we'd finished a high degree wave three. So we're then looking at the relationship from all the way back over here. Big move. So we're looking for the relative pullback of that. And it's gone reasonably deep. Spot 618 is where we were looking midweek. We said I expected it to come and test the 152 level. If we tested 155, bounced off it, it was then a case of is that relevant anymore, or is it back to the barrier level 152? Which, if you remember, is the thing it took years to break out of, or a year or so. So we had that 22 top, and we had the 23, and then we had it in as a barrier, looking like a barrier triangle, getting ever closer to it. We thought it would break out and then become eventually support, which is where we are now. So going into breaking that, we'd seen big 152 options and 155, and these 160s, 158s and 160s. We've now come all the way back. It's stopped just within what we like to see as a valid for a wave, for a three-wave pullback. Even within that, what I've just been saying. It's fairly close to the 1.5, the 100%, but we know that there was a reason why 152 would hold, because it's massive, probably still offside hedge book sat there trying to get their positions back on board from being short the options. So a valid place for what was a double extension in the end. We had a three-wave there, extended, came down to here, another connector, and then this almost equal legs for the whole move. So I'm happy that we're in the right place. Again, that gives us, if you're going to play long yen, 152 is the real line in the sand. So make sure that you're out at 152 if the bodge does anything. And in the short term, it may move, and they may do intervention if the Fed does something on Wednesday night. Are they going to do that? Probably not. But we'll have the Bank of Japan first, won't we, in the morning? Just so I'm not gone completely mad, I'm just going to confirm that. Yeah, 4 a.m. Wednesday, we'll hear from the Japan, the Fed in the evening. So there's two opportunities on Wednesday for something to happen. Obviously, whatever they do themselves, whether that's good enough, and then if the US signal anything on Wednesday night, because the rate cut probably isn't coming, but they might use any kind of rally up here on disappointment. If the conference speech, post decision speech from Powell is super dovish, then we might see some Japanese buying. But you'd like to think that they will have signaled something much better, and thus negating having to do that in the morning. But like I said, make sure you're out at 152 or somewhere around there, just in case. If the conditions come in correctly, we're coming into 145. So just be careful. At the moment, that is super valid for a bounce up. It's telling me, the chart's telling me that Japan's going to mess up relative to US because at some point this is going to a new high. So even if they do something now, and even if we've got the US rate cycle starting, somewhere in this, we still need to put another high in. It may just be in the terms of the way we're going to go into what we're going to get strong. Yeah, so that lines up with building up for the August breakout on dollar flows. So if the Japanese aren't signaling well enough into that, then we will get that next breakout based on dollar flight to safety flows. Any questions on you, Jay? DAX, annoyingly, we said these are all the same idea. It's either breakout or further consolidation. Yellow is the line in the sand. So yet again, we've bounced off that, and that's your stop loss. We've regained the 50-day. Is it going to hold? Pretty much like the rest of the things in the bigger picture. We're not a million miles away from back in the overall upside channel for this blue wave 5. So that's what we're hoping for. A grind up, but it looks like seasonally we might just be touching into that channel for the DAX until things change. I think the ultimate wave 5 is going to come later in the year by the look of it. Choppiness ahead for Mr. DAX, but it should have a bullish slant on it in the short term. So Nasdaq is the tricky one. Obviously, that's the one that's getting all the heavyweight momentum. We had an overthrow of the original up channel, the original blue waves channel, 4 down here and 5 there. Thanks, Shabazz. Thanks for your input. We were playing the wave 5 with the 1, 2, 3, 4, 5 and up, which we were hoping to get an overthrow to the top of that channel, but it was a weak. It's ended up being, in terms of the high degree wave overthrow potentially, but I'm still not convinced that the upside has finished. All we've done is roll the degrees forward. I've been trying to find a reason to have a really complicated finish. I really want to find a simple way, which is the best way of doing technicals. Don't try and fit the technicals to narrative, but there's a very outside chance that the reds haven't actually finished and that we're still in a 4, but that would mean that we're doing a massively expanding triangle or diagonal ABC. Normally They're 1.618 of the preceding waves. At the moment, these are running at kind of nearly double of the previous wave. It's not impossible that that's the case, in which case this could be a valid finish for wave 4, and we've still got to put a big rally for a wave 5 overthrow in there, or it could be doing an actual 5-wave A, B, C, D, E triangle. But I'm going to say this is super low potential just because it's big multiples. It's almost as if I'm trying to fit stuff to make it work. So I'm kind of ruling that out and saying that the 4-wave channel just truncated. So that has put us into the fifth of a fifth of that primary wave 3, in which case we would be coming back across to the other confluences. And I've got this on a daily chart just to show you where the 3, 4, 5 should be. No, it's not that one. Yeah, so given that 1 and 2 were back here in summer last year into the October low last year, and then if we have put in a wave 3 top over here, so this having moved down, we've accepted the 3, 4, 5 is over. This is wave 3 here, and we're dealing with this green channel, in which case that gives us wave 4 at the other side of the channel. Now, where are we within this move? I've said already we've done a deep consolidation, almost 1 for 1. That's taken us down to 18,700 before we bounce today. The middle of the week, we're saying 18.5 is a potential area to come back into, because that is the previous degrees 4th wave, 3, 4 over here, which was the April sell-off. And it's quite connected because it was on exactly the same ideas and the tech unwind, and then we had at the starting point of it quite poor before the results from the Mag 4 that we've got this week suddenly taking us on, and NVIDIA confirming it. So we've got a similar setup, but at a higher degree. So you'll expect this pullback to be slightly bigger, which it is. So it's got that 18,200 as a kind of starting point target area. Obviously, we've gone through the other wave 4, or the other wave 4 now. If that is wave 5, is down here. So we've gone through that wave 4. So we're in the middle of 2 areas that we'd be aiming for on an equal legs. That's telling me that we're going to have a bounce. It's all a case of whether that is actually the end of it and we go to new highs or not. So I go take that down to the 1 hour again. Actually, that was it. The weekly is clearer for that. So the 1, 2 back here, intermediate waves were at the back end of last year as well. So within this structure, we've got the April sell-off as a 3, 4. And we just put in that whole wave 5 to complete the primary wave 3, which we're now tracing out the wave 4. Spot 2, 3, 6 and spot 3, 8 are classic areas for where that wave 4 would finish. Again, that is around 18,400. So we've either got one more in it, or we've come in with a super shallow, oversold. To me, 24% outperformance of Russell versus Mag 7 is a bit extreme. So hence, that's why I'm happy to have a trading buy in the short term through next week. If the Mag 7 disappoint, then it's all bets off, and we'll have to reevaluate, because then we're probably looking at a double for 4 moving down to the 38 retracement, which takes us to 17,000. That is the obvious. There we go. So at the moment, I'm playing it with the sort of 18.4, 18.5 as a sort of stop area for being long the Nasdaq. Right. have one more little chop. I don't want to get locked in at the other side of the first instance of the channel for no reason. I want to see proper breakdown. So on the hourly, again, I say we're close. We're close to that equal legs. We're close to the channel for what was the blue waves previously. It was an important area. This is wave 4, just a little bit further down. The full channel takes us down much lower. So for now, I'm willing to play, like I said, down here, the intersection, just an overthrow, 18.4, 18.5. If we go much further below that, then I think we're going to be in doing a double territory. We'll just have to time the entry a lot better. There might be a relief rally back to where we are now, but we'll ultimately go down to that 17,000 level. So fingers crossed, but we should be moving up here back into the mid 19,000s really before it all deteriorates, if it's going to. But you know, this is, like I said, this is an important week, just like it was in April. Yeah, late April, we started moving up. So don't rule out this ultimate top that I'm talking about into the middle to end of August, and then move out of the way because we are into. I've got it on here, but that will be 5 primary waves. That'll be a cycle top, and then you're talking, a 38% pullback from that wave is going to take you back into this sort of 17, 18,000 level quite sharply. So I think the other indices just tag along with that. Japan, we got stopped out on because we wanted it to test 40,000, didn't we? And we put in a 1.618 was going to be our stopping point for the long, obviously, because it's been the Nikkei has been the big outperformer for the year. We're talking about carry trades unwinding. You got a lot of overseas money pulling out. You've got money coming home. Blah blah blah. Lots of carry trades unwinding from the yen. Then this has just got a little bit overdone. Again, this is quite extreme. Should have a bounce, but I need to see a clearer picture of the whole yen carry trade before we get back involved on investing in the Nikkei. Obviously, once things settle down, I think when we get into the sort of September selling off period, this probably becomes a relative buy again. But for the moment, I'm staying out because it's done more than what we wanted to. I think it tries to take back the 50-day, probably fails, put in a double. And again, that means that's all still valid because we're at a higher degree. Wave 4 here. So that wave 4 there's only a target area. We've got a lot more to play with for the wave. The wave 2's down here at sort of 30,000. So this is not a knife to catch after the outperformance it's had until we get a picture on what the Bank of Japan are doing. So don't get caught up in this unless you really know what you're doing on the yen. FTSE, someone was talking FTSE, weren't they? And that's interestingly had a little break of the 50-day. But as I said last week, I think this one is stuck in this range we have. And as we said, I think that is the wave 4. I don't think we haven't put the wave 3 in yet. I said near 8,000 and it came in near 8,000. I didn't buy because I was looking for break of 8,000. So yet again, an annoying jump of 3%. But again, there's still potential for this to have more sideways consolidation in it. Putting in a sort of X connector, which could be a 3-wave. We might get up to the height of the previous X, just a little bit below. But all really depends on whether it gets dragged along with sustained strength from other indices. But at the moment, I'm feeling it's going to be a tech-driven bounce back rather than necessarily the markets at large. So I'll stick with what I said on Monday, that I think this will end up not putting in this wave 3 just yet. KG, who's the giveaway? What's the giveaway? Unfortunately, I don't know anything about that. I do apologise. Crude oil, that isn't really happening, is it? That is doing a double again. I mean, it's broken through the lower end of that. It can go to, let's put 1.618 in. But that's becoming a deep retracement then. As I said the other day, the danger with oil is that demand destruction is here a little bit earlier than what's thought, and certainly what OPEC anticipated. But at the moment, we'll leave it as a classic. It's still a consolidation at the moment until proven otherwise, and really we need a lower low to prove that, and that is through here at 73.77, isn't it? Oil still one not to play at the moment. Not happy either way. If you play it, you've probably got a better idea. Just our usual. We had the spike on the VIX, which is now coming back down. We'll have a look why we sort of expected that might happen from what we said on Monday. We need to see it go into 20s and stay in the 20s for kind of sustained sell-off. Bonds are still trading fairly neutrally. There's been a slight uptick in the last couple of days, but nothing really major of note. And if anything, money's coming in. The rate cycle is going to be helpful. So not worried about the volatility in bonds. Equities just seems to be drifting back a little bit. Back into 17. Move index is more or less neutral at 100. The one we want to look at is this fixed trend. Remember, we showed this on Monday from the October 22nd, start of the 22nd sell-off, 2022 sell-off, top of the market, blah, blah, blah. Everything got very messy. We've been stuck in that channel ever since, rallies into the lows. It's obviously flatlined, and we talked about that historical flatline level. I mean, ignore that breakthrough last week. That was Mrs. Biden knowing that Joe was giving up the presidency. But we were saying it's the uptrend that we're interested in. It's touched it a number of times in the last 2.5 years. We've touched it again during the week. In fact, probably yesterday, wasn't it? As we saw from the other chart. and now it's just drifted back. We're currently here at sort of 16 and 3/4, 17. Do we go back to the mid-range? We see and possibly below. Looks like mid-range, isn't it? Is where we stopped. See that sell off a little bit more, rally back on, certainly for the short term. And again, you saw that with the advanced decline line, everything going down Wednesday, but Thursday started to see a little bit of an unwind of that. The markets were still ending up on lows, weren't they? We're back into that oddity of um, negative correlation, which possibly is supporting the early parts of moving back into the longer tech. But we'll have to look at that. We'll keep an eye on that. This is just a backup indicator, not anything that should lead it. So any other questions on anything I've talked about, or anything that you want to ask before we finish? Good look out there. I think we should be playing the small bounce back trade that we are. Gold is continuing to trade. Nasdaq's holding on. FTSE all depends on the underlying stocks within it. DAX looks like it's not going to have new highs short term. All leading into, let's not fall in love with this. We want to see a breakout, hopefully a new all-time high, and then the idea is to then get out of the way in August, middle of August, hopefully, leading into NVIDIA. So opportunities abound, but we've done a lot of negativity. We're against some big supports. So as long as they hold in the short term, we're in a rebound phase. But keep them in mind for everything unwinding. Listen to all the chatter from the central banks, and obviously Wednesday is a big day with the Mag 7 as well. So have a lovely weekend then, if there's no questions.